Okay, good evening, everybody. We're getting ready to do our live session for chapter 9. We don't have anybody that's attending tonight's live session. So I'm going to go ahead and just record the video and get it posted for everybody. And a couple of housekeeping things before I get into the actual lecture tonight. First, what I want to do is let you all know that I'm going to stop with the live sessions. The next two chapters, 10 and 11, plus a special video I'm going to do on the final exam. They're all just going to be videos. I'm not going to actually do a live session. If at this point, if you feel you need some one-on-one time to discuss the material and to ask questions, my schedule is fairly open right now. The tax season is over. I can pretty much schedule any time that I need to schedule with you all without a problem. The only problem will be scheduling something on Wednesday nights because that's when I have my face-to-face accounting class. So can't do that. So anyway, just be advised that again, we haven't had anybody attend in the last 3 sessions. So I'm just going to go ahead and move this to a video. I hope to get it up on Sunday night. If not, it'll definitely be up by Monday, as I have been doing. So we're going to be talking about liabilities in chapter 9. And as you can see by the first slide, there's 3 different types of liabilities. Past due transaction, an example of this would be you get a delivery in from a supplier, like a produce company, and you check in the order, you sign the bill of lading, give it back to the delivery person, and then you'll get an invoice in the mail later on, giving you a certain amount of time to pay the bill. That's an accounts payable type transaction because you're not paying for the item right away. It's going onto your account. So that's an example of past due liability. Then we have, the company has a present obligation. So, and this is a good example, this is payroll. You get done doing payroll and paying your employees, and you have to pay the state sales, the state withholding, the federal withholding. Maybe you have a deduction on your paycheck for health insurance or savings plan. These people have to be paid, but you don't sit there and write them a check when you're cutting the check for your employees. You'll pay these usually once a month. And so that's considered a present obligation that becomes a payable. And then finally, future payment of assets or services. So I think we've had the example in unearned revenue where you have customers signing up for a magazine subscription. You're going to record the revenue as unearned revenue because you haven't done anything yet until you start shipping them magazines, right? So that's going to be a liability. And then all of these are that I described are current liabilities because they're all going to be disposed of within 12 months. My clicking is slow. Okay, so we have current liabilities. These are liabilities that are paid within a year. And long-term liabilities go out longer than a year. And usually current liabilities are going to include what used to be a long-term liability, but if it's within a year of maturity, then it would be considered as a current liability. So when you have liabilities, you have uncertainty at times, and we'll get into this at the end of the chapter. Uncertainty on who to pay, when to pay, and how much to pay. But you can estimate pretty closely what uncertainty and risk are. And again, we'll get into that at the end of the chapter, but they are considered liability. So if you're facing a lawsuit, or if there's a potential for a lawsuit, and you're going to pay that out, then you need to make sure that it's recorded in books, and we'll explain how that happens. at the end of the chapter. Known liabilities are accounts payable. I just gave you the example of that. You're buying stuff to resell, or maybe you have to bring out a service person like a electrician or a plumber or something of that nature. You're not going to usually pay them when they arrive and do the job. Usually, if it's a company you have a relationship with, you're going to sign an invoice or a bill of lading or a service work order, and then you'll get a bill in the mail later giving you, and we've seen examples of this with the 210 net 30 example. Sales taxes. If you're a retailer, you usually pay your sales taxes. I can tell you, they're due in South Carolina on the 20th of every month. The 20th of every month, I got to take my clients' information on what they've sold that they have to pay sales tax on, and I have to report that to the Department of Revenue. You have unearned revenues, which I just described, the magazine subscriptions, or maybe you're a landscaper and someone pays ahead for your services. In my case, I take on clients sometimes that have to give me a retainer. And so what I will do is I will go ahead and take that retainer, and that becomes unearned revenue until I do start doing the work. For those of you that have to report to me that you've watched the video, report back in an email that the dog that barks name is Pinky. So those of you don't have to report back to me, then you don't have to worry about it. All right, next we have notes payable. This is where maybe to keep an account open because you've gotten behind on an account, you agree to sign a note so that they'll keep delivering stuff to your door. But you'll pay it off in less than 12 months. That would be an example of a note payable. Payroll obligations. This would be a situation where, the pay week ends on a Friday, right? But you don't get your paycheck for 2 weeks for that particular pay period, that 2-week pay period. Companies, need time to process payroll nowadays. So the fact that you've earned money becomes a salary payable. The taxes that are deducted become taxes payable. We're going to learn what employer obligations are because, if you work for somebody, you're going to have Social Security, Medicare withheld, and the employer has to match that. And not only that, they also have to pay something called FUTA, F-U-T-A, federal unemployment tax, and SUTA, S-U-T-A, or state unemployment tax. In South Carolina, that state unemployment tax is run by an agency called DEW, Department of Employment and Workforce. Then you have multi-period known liability, and we'll get into this again towards the end of the chapter. All right, so first example is sales tax. Home Depot sold materials for $6,000 that are subject to a state's 5% sales tax. So, in fact, so that in South Carolina, it's 6%, not 5%. But in our example, it's 5%. So we're going to debit cash for $6,300. Then we're going to credit sales $6,000. And then we're going to credit a liability called sales tax payable, $300. Then the following month, by the 20th, in South Carolina, we would have to send in the accumulated money in that account through the 30th, through the end of the month. That's how it works in South Carolina. So I just finished last week paying sales taxes for September. So for whatever sales taxes my clients had, it went into sales tax payable as they sold their merchandise. And then I cut a check to the state of South Carolina for the amount that they had to pay. Unearned revenue. On June 30th, Selena Gomez sells $900,000 in tickets for 3 concerts. Never understood how she could sing because I've heard her talk on Murders in the Building, and it doesn't sound like a very melodious voice to me. But anyway, that's my musical opinion. So Selena sells $900,000 in tickets for 3 concerts. she debits cash for 900,000 and then credits unearned ticket revenue, which is a liability. Don't get it confused with revenue. It's not a revenue account. It's a liability account for 900,000, and the money's going to sit there until she actually performs. Then when she performs, let's say she's performing a concert where the revenue is 300,000 per concert, then the day she actually performs, which in this case is October 31st, we will debit unearned ticket revenue 300,000 and then credit ticket revenue 300,000. Again, our accounting principles tell us that we can't actually capture the revenue until the services are performed. And that's the reason behind that. Short-term notes payable. And this is what I discussed before. It's a written promise to pay. It's like a promissory note. We looked at that already. Under accounts receivable, most notes all notes will bear interest. Most notes will bear interest. It's an incorrect assumption to make that there's some notes that won't, because GAAP requires if there's going to be economic substance to a loan, there must be interest, and the IRS requires that as well. If you are lending money and you're not charging interest, the IRS will tell you what you should be collecting, and you'll have to pay taxes on that. That's mostly done within families and such, and they don't like that too much. It's a way of trying to circumvent taxes. That's why. And you can see overdue account payable, which is what I talked about. You're trying to keep a vendor happy, so they keep delivering to you, so you don't lose sales, and you'll agree to do that because a note payable has a higher level of collectability than an account payable does. You're better able to go before a judge and get them to order collection on a note payable than you will an account payable. Okay. And that's why banks require it. They want some kind of legal recourse if you don't pay. In our example, Brady Company asked McGraw to accept $100 cash in a 60-day, 12% $500 note to replace its account payable. So we're going to debit accounts payable, $600, which removes the account payable that we were behind on. Then we're going to debit cash $100. Credit cash $100. And then we're going to credit notes payable $500. In this example, note given to extend credit period, date of payment. So they pay the note plus the interest on the due date. That means we're going to debit notes payable, which wipes out the obligation to pay. We're going to debit interest expense $10, and we're going to credit cash $510. In a note given to borrow from a bank, you can see when we borrow on September 30th, we're going to debit cash $2,000 and credit notes payable $2,000. And then when we pay on November 29th, we will debit notes payable $2,000, debit interest expense $40 because this is an expense, and then we're going to credit cash $2,040. When a note extends over 2 periods, so what are we talking about? Well, let's say we're doing our books annually. So when we might take the note on December 1st and then have to pay it back on February 28th. We're extending over 2 periods. So we have to account for things in the period where they occurred. What are we talking about? We're talking about interest. We're going to have adjusted entries for interest, right? We've already looked at that. This is kind of like what we looked at in accounts receivable, but in reverse, because we're the ones paying, we're not the ones collecting. So on December 16th, company borrows $2,000 from a bank at 12% interest for 60 days. We're going to make an adjusted entry. The interest happens to come to $10 for those 15 days. So we're going to debit interest expense $10 and credit interest payable $10. This is where the payable comes in. We're not going to pay the interest until we pay the note in full. but we have to capture the interest expense in the year in which it accrued, okay? And so for those 15 days of interest, that's what we're looking at. Then when we go to pay the note, we're going to have 3 debit entries. We're going to have an interest expense of $30 for January 1st to February 14th. This is 45 days. Then we're going to debit interest payable $10. That wipes out capturing that expense in the year before. We're going to debit notes payable for $2,000. That wipes out the note. And we're going to credit cash $2,040. All right. So as I mentioned, payroll liabilities come from deductions in your paychecks. All right. And so we're going to have to, at some point in time, pay that money to somebody else. And you can see examples here of what all gets deducted from paycheck. Those of you that work already know that. Now, FICA taxes, FICA stands for the Federal Insurance Contributions Act. It consists of 6.2% in Social Security and 1.45% goes to Medicare. There is a cap, and it's like for 2023, I want to say it's 168,000 now. It's really gone up, that you're going to have 6.2% deducted before it goes away. 1.45% will be collected no matter how much you make. So if you make $1 million a year, 1.45%, I'm sorry, 1.45% is going to be deducted. These withholdings have to be paid by the IRS. If not, they are considered trust fund. Right now, I am representing several clients who did not do this. They decided to use the money for personal reasons and not send it to the IRS. So I'm negotiating with the IRS to keep them from going to jail right now. Really not that serious, but they could. The one thing the IRS will criminally charge you for is withholding, not sending it to them. Now, here's something to consider, though. The employer has to match what's being deducted from your paycheck. So think about that. There are costs to hiring you as an employee that you don't see. And we'll get into some of those in a minute. Then we have withholding requirements. So y'all understand that you're going to have your income tax withheld at both the federal and state level. Sometimes some cities will have a local income tax, such as Philadelphia, New York, and Chicago. They're the ones I know of. I'm not aware of any others, but there are others out there that do that. Then you have your voluntary deductions, which is insurance, pensions, and union dues. Maybe United Way. Maybe your employer has a savings club. You know, they were big at one time. They call them vacation clubs or Christmas clubs, so that you'd be able to pull out your savings at the end of the year for those 2 reasons. So when payroll is cut, right? Let's say you have an employee who makes $2,000 a week. You can see what the deductions are. You're going to debit salaries expense for the full amount of what they earned. That's important. Keep that in mind. And then you're going to credit the liabilities, which is the money that was deducted. It has to be paid out to somebody else. So you can see that we're going to credit Social Security tax payable, Medicare tax payable, federal income tax payable, medical insurance payable, union dues payable. Not in there, but it probably should be a state income tax payable. And then you can see the last entry, the salaries payable, because I don't know of a single employer that cuts their payroll checks on the day that you get on the last day of the pay period. All right, it's usually a week or 2 behind from when the pay period ends. And then when you go to pay the person, you will then debit salaries payable to remove the obligation to pay them. And then you will credit cash to the amount of the check you're writing. Okay. Again, I want you to note that the salary expense, which is the gross wages, before deductions is going to be debited on the day the pay period ends to reflect when the services were actually performed by the employee. Now, when you pay the employees, you then have to do the employer portion. As you can see, FICA for Social Security and FICA for Medicare equal whatever you deducted from the employees. So these have to be recorded in your as employer taxes as liabilities. Because what you're going to do with these is these are normally paid monthly by the 15th of the month following the end of the period that you're covering. So again, in October, by October 15th, I had to send in, actually the reports go in quarterly, but I do have a couple of clients where I have to pay the employer share along with the withholding by the 15th of every month. So September's earnings went in by October 15th. And then you have federal and state unemployment tax. Federal is paid at the end of the year, but you're going to put aside the money as you realize it. And then the state is paid quarterly and has to be paid by the 30th of the month following the ending of the quarter. So for federal unemployment tax, it's 6% of the first 7,000 of wages paid to each employee. But they will give you credit up to 5.4% for state unemployment tax that's paid in. All right. So your real rate is 0.6% that you pay the federal government. The only time this is different is when the state borrows money to fund their unemployment insurance. And what happens is the federal government will not allow the credit for employers in a state that is behind in paying the loans. And this happened back in 08, 09, and 2010 when money had to be loaned by the federal government when the economy crashed. And South Carolina was one of about a dozen states that didn't pay it back right away. And they were threatened with the employers in this state not being able to take this 5.4% credit. Think about it. If you're BMW, that's a kick in the butt. And this is where politics come into play. They start calling the governor and saying, figure out a way to make it happen. State unemployment tax is 5.4% on the first 7,000 in wages, but this can be adjusted. Okay. This rate can be raised or lowered depending on an employer's experience. So if they have high employee turnover, you have a lot of claims going in to do, they can increase your rate. They will increase your rate to where you're paying in more in unemployment tax, and vice versa. If you have a great record, you could pay less. So that's how that works. When you're recording payroll taxes, okay, what's happened is you've just recorded the payroll expenses that we just covered, okay? Then you're going to turn around and on the same day, you're going to have to capture the payroll tax expense. So the payroll tax expense is the amount of your employer matching for Social Security, Medicare, then state unemployment and federal unemployment. So as you can see here, you're going to, and this is a new account. This is not the same as salary expense. It's called payroll taxes expense. It's for what the employer has to pay. It has nothing to do with what the employees have withheld. And then all these things are posted. You can see that Social Security tax payable, we're going to put the $124 for the employer side. Well, that's also the same account as where we're going to put the employees, because when we go to pay the federal government, we're going to add all that money together. So it's going to all come out of that same account. When we're talking about accounting controls, controls have to be implemented for payroll, especially because this is an area where a lot of theft can occur in a company. Doesn't happen in a company where you have 3 or 4 employees. But when you have hundreds or even thousands of employees, you have to have a process in place to make sure that people don't try to steal by what's called ghost employees. Um, so you have to have controls during the hiring process, during your payroll preparation, the timekeeping. You don't want employees clocking in and out other employees, um, and then payroll payment. Multi-period known liabilities include unearned revenues and notes payable. Unearned revenues being the biggest of the two. And again, I gave you the example of magazine subscriptions, but it could also be the other two. Like people will pay ahead of time for the year for landscaping. They will, attorneys take retainers all the time. Tax professionals that do representation in my world also take retainers. If you come in and want me to negotiate with the IRS, I'm going to ask for X number of dollars up front, simply because if I'm negotiating with the IRS, they're going to want to know what you actually have, and I don't want them hitting into money that you otherwise would pay me. Estimated liabilities. This is, as we can see, it's a known obligation of an uncertain amount that can be reasonably estimated. Now, we have examples here of pensions, healthcare, vacation pay, and warranties. This also extends to lawsuits too. I mean, it's gotten to the point with lawsuits that if you are subject to litigation, they get pretty close to estimating what you can win in court. It's amazing how they generate these numbers and how accurate they are. So in this example, for health and pension benefits, we have an employer agrees to pay for medical insurance equal to $8,000 and then contribute 10% of employees, $120,000 gross to a retirement program. So we're going to debit employee benefit expense, then we're going to credit employee medical insurance payable, and then employee retirement program payable. And these, medical insurance is usually sent in monthly, but retirement is usually done once a year after the company sees how much it's made in profits, especially if it's a sole proprietor or partnership, because the rules for them contributing to retirement are tied into what they earn. Under vacation benefits, you can see here where at the end of the year, we're going to determine who's eligible for vacation benefits. And so because, you've earned your vacation benefit, say in 2021 by the number of hours worked and days worked, then you take your vacation in 2022. So again, the matching principle at play here. So in order to determine that, you're going to have to debit vacation benefit expense because it was earned in 2021, not 2022, but you're taking it in 2022. So that carryover comes from the vacation benefits payable that is your liability. And as you can see, if a month later or 3 months later you take a vacation, you're going to have vacation benefits payable debited to the tune of $400, and then you're going to have cash credited by $400. So the way you carry those benefits over that are earned in the prior year is you put them into a payable account. The bonus plan is assume a bonus of $10,000 will be paid to employees to be shared by all. You're just going to debit employee bonus expense $10,000 and then credit bonus payable $10,000. And then as you pay out the bonus, you will debit that account to lower it down to zero. Now, warranties are, it's just a different thing altogether, but it's still going to be a liability until it's paid out. Every time you buy something, everything has a warranty, and that's built into the price of the product. They pretty much know to the penny what they're going to pay out in warranty claims because of historical data. So to replace or fix a product, that money has to be set aside for that in the year the sale is made. Okay. So if you buy a car in 2021, you may have a warranty expense in 2023. Well, that's already been put into a payable account waiting for you to come in and have the repair done. In our example, dealer sells a car for $16,000 with a maximum 1 year, 12,000 mile warranty. Past experience indicates warranty expenses average 4% of the car selling price. So when the car is sold, you're going to have a debit to warranty expense of $640. Because again, the car was sold in 2021, even though the repair might be 2 or 3 years later. And then, well, this is a 1 year warranty, so it would be done within the next 12 months. Estimated warranty liability is going to be credited $640. Now, when you take the car in, you get the part replaced that's defective, you're going to have a debit to estimated warranty liability, which is the liability account. And then you're going to have a credit to auto parts inventory. Okay. Oversimplification, I know, but they wanted to keep it simple so that you can see how it plays out. Now, contingent liabilities. This is where you have to deal with future events because, you know, GAAP requires that we report all things that are going to affect the profitability of the company and the balance sheet and the income statement and statement of cash flows and other financial reports that you have not learned about yet. If you ever open up an annual report, you'll see there'll be like a balance sheet, and then they'll have 4 or 5 pages of notes. These are called notes of financial statements. So when you see over to the right, disclosure and notes, that's what we're talking about. And I'll give you an example about that in a minute. So if we're looking at a future event is probable, what would be an example of that? Well, maybe you've been served for a lawsuit. Okay. Somebody, you own a McDonald's and somebody is, you know, somebody spilled coffee on them and they're suing them. Okay. Well, because there was a prior case 20 years ago, there's a pretty strong probability you're going to lose, and you can pretty much estimate what you're going to pay out. And so you're going to record it as a liability. If it's a lawsuit because you did something else, and it's been very seldom tried in the past, but it's, you know, you're going to court and you don't have a handle on how you can estimate what the cost is, then it's going to go into disclosure in the notes. Let's say if something's possible. All right. Let's say that you decided to build your restaurant on the beach. And you know it's possible there's going to be a hurricane hitting you because you're on the Gulf Coast or you're on the Southern Atlantic coast. You'll put that in the notes in the financial statement too. You know, you'll say what the percentage is of hurricanes that have hit in the past and that this may hit and wipe out your business. Okay. Remote it requires no disclosure. All right. That 1 in a million thing that may happen to you. Okay. And again, here's some examples of potential legal claims. I'm sorry, contingent liabilities or potential legal claims, which I just discussed. Debt guarantee requires disclosure in the notes to financial statements because you're not really setting up an account for that. But if you're, say, the owner of a single member LLC and you decide to sign a note guaranteeing something, you got to put that in the notes to financial statement. And other contingencies, you can see environmental damage was real big for a while because a long time ago they used to build with asbestos. And when they, you know, first did it, nobody knew what the hazards were. But as people started dying from lung cancer from it and other lung diseases, then it became a big deal. And if it turned out you had a factory that was built with asbestos you had to disclose that. And uncertainties that are not contingencies, again, these are, you know, 1 in a million things that could happen to you. Okay, our formula for the week is times interest earned, and it's income before interest expense and income taxes divided by interest expense. What are we measuring here? Well, we're measuring the ability of a company to pay its interest, because what happens is if a company over borrows and it's paying and it's getting hit with an interest expense of more than what it's earning in profit, you're insolvent. Okay. Your creditors are going to be forcing you into bankruptcy. So this is an important number that you have to keep track of. So that's why this is an important formula, and also tells you, it goes to the financial health of the company too as well. Now, why do we pull out? And if you look at an income statement, you'll see that interest expense and income taxes are below the profit line. All right, so you'll take your revenue, you'll minus your expenses, you'll have your net profit or loss. Then the next two lines below that, which are calculated separately, are your interest expense and income taxes. You'll see this more when you get into higher level accounting classes. That's where it's more prevalent. It's not something you'll see in 101 or 102. Let's see. And that's the end of chapter 9. I will be getting this posted by the time you see it tomorrow. Again, if you have questions or if you need any one-on-one time, don't feel free to contact me. I will say this, for some reason, students don't want to get on the phone and talk. They want to do Zoom, or they want to do it all by email. And email cannot solve every problem, because some problems require a back and forth. Zoom is sometimes just a waste of time when it can be resolved on a phone call and have a discussion for 2 or 3 minutes. It takes time to set up a Zoom meeting. And, you know, I had one Zoom meeting where the whole thing could have been done over the phone. You know, we spent about 15 minutes discussing what a student's issues were having. But again, you know, a Zoom call with nothing to show on my end or their end, it was just a waste of time, and it was better done by doing a phone call. So, but what I want you to do is email me first. We'll set up a time when we can meet, and you'll have my undivided attention for however long it takes to resolve any problems that you're having. Okay. So with that, have a good week. Good luck with your test Monday night. And I'll be back next week with chapter 10 video.